Hey everybody, Brian Shannon here from alphatrends.net. It's Saturday the 28th of February, so let's go ahead and take a look at how the stocks ended for this week and what we can expect for next week as well. We had a great month for equities, obviously. The S&P 500 up 5.5%, Nasdaq up 7.2%, semis gained 8%, so just big numbers all across the board. Oil bounced a little bit, but still clearly in a downtrend. The IYR had a tough month, and that was actually, the bonds were down 6.3%, and that's going to affect the IYR. So let's take a look at the action on the charts, and we're still clearly in a longer-term uptrend on the daily time frame of the S&P 500. We did close just below that 10-day moving average on Friday with a little bit heavier volume too. So when we drill down to a shorter-term time frame, we've enjoyed a very nice rally here from the early February to the end of the month here, and we're looking at it on a 10-minute time frame. You can see that this is an important level that we're going to want to see hold next week, 210 to 210.5. We did close below the 5-day moving average on Friday, so that's going to put us in a little bit of a cautionary mode going into early next week. And in order for this to become bullish on the S&P 500 again, I think that at a minimum we're going to need to see it back above about 211.70, back above and holding above for at least a half hour. So it's dangerous to short this market still because the primary trend is still higher, and it's dangerous to buy it right now because while it's below that 5-day moving average. But if it can get back above there and hold above it, then it looks like the uptrend should continue. Just a little bit of caution going into next week though, because of the magnitude of the rally that we've had recently without much of a correction, and now we are starting to maybe see a little bit of slowing down. I wouldn't expect for this market to come caving down, but some pullback or at least a correction through time would certainly be welcome, I think, for the health of this market in order to rebuild some energy for which to launch to higher highs once again. So just a little bit of caution going into next week. The Nasdaq had a great week, great month, and here we can see that this market as well is kind of dancing on a little bit of support here at this 108 level from last week. So if we break the 108 level, then perhaps, and if we break below and hold below for more than a half hour or so, then I think we could start to see a little bit deeper pullback. We also see that this is the trend line from the last month as well that we've touched, that we're on. So I think breaking the trend line doesn't mean we're going to see a pullback, but breaking below the trend line, holding below it, and then seeing a lower high and lower low below a 5-day moving average, which begins to flatten and then turn lower, that would be the danger here. So below 108 next week, if we stay below that for more than a half hour or so, put your more cautionary mode on, I guess, would be the way to do it. And if we start to look for retracements from this rally, you can see we'd have a long way to go just to get to a 38.2% retracement. Would bring us all the way down to 105. Now that's not a prediction; it's just something to be aware of. That after a big rally like this, if we begin to pull back, it might be a little bit deeper. So don't be so quick to look to buy the dips. Don't be looking to buy at a 10-day moving average. Look at the action at a 10-day moving average on a shorter term time frame and see if that is in fact where the market tells you is a good place to purchase. The Russell 2000 closed lower on Friday by a small amount, but for the week still managed a small gain. And for the week these markets were actually pretty mild compared to what we saw for the month. So perhaps it's a little bit of distribution or before decline, or it's more just sideways type of churning action that we'll see develop in here. But anyways, back to the Russell 2000. This kind of represents the essence of trend. You can draw a trend line off this low, and either way, I think that this is more representative of, again, the essence of trend. But we can see that just below here, we have at about 122, 122 and a quarter, we've got this prior little band of resistance, which should hold as support. If it does not hold as support and we see a pattern of lower highs and lower lows, then obviously we want to become much more cautious until the market tells us once again. So the primary theme going into next week is that this market has had a very strong rally, and it's starting to show signs of fatigue. It's not showing signs of breaking down. It's showing signs that it's at a potential level where it may break down, and that's where we were earlier in the week coming in with the semiconductors. That this group, 56 to 56 and a quarter, it looked like, we spent one day where we closed below that 5-day moving average, so we became cautious here, but it did get back above it and went to make higher highs and higher lows. So looking at this chart of the semiconductors last week and where it closed right here compared to where the S&P 500 is right now, it's very similar. That's why getting back above 211.75 would put us back in bullish mode, similar to the way that the semiconductors got back above that 56.50 level. So the semiconductors did have a better week, obviously, and they maintained this strong momentum that we've been seeing. And right now, the bigger support is down by 56 bucks in the semiconductors. So we've got two important levels below us. So really 56.70 to 56.75 would be our first little band of support, and if that breaks and we hold below it, then we would be in for a test of 56. If 56 fails to hold, then I think we start to see maybe a deeper correction, but right now there's no evidence of that. It's just markets are showing a little bit of signs of fatigue, not of breaking down, but of fatigue. Now for the financials, I had mentioned to subscribers on Thursday that we had seen this breakout and then it failed, so we had to be aware of the possibility from a failed breakout could come a faster move lower. So we've been looking at this level of resistance here since basically the beginning of the year. The financials have had a nice run right up into there. They tried to poke up through there, couldn't hold. So perhaps we're going to see a little bit further pullback down towards the 20 and 50-day moving average near about 24 and a dime to 24.20. I think that's the key level really that this market needs to hold. So same thing here is that we're seeing a little bit of distribution, it looks like. Not a reason to be aggressively short. If you're going to short it, I think that the shorts that are against the primary trends ought to be for very short-term trades, smaller trades as well. But there's certainly a case to be made for intraday trading on the short side when we are below a declining 5-day moving average. But it's a skill set that you have to be comfortable with and learn and know that that's a time frame that you're comfortable with. For most people, it's probably not appropriate. Let's take a look at some other things, such as the Biotechs, which had a strong week also. The Biotechs this week showed a gain of, well, about 0.5%, but they're still, clearly the leaders this year, up 11.25%. I had thought that maybe we would see a little bit further strength in these Biotechs on Friday because a couple of the big names in there, such as Celgene, Celgene's hanging up near these highs, and it looked like maybe it had the possibility of moving higher, and Amgen had just shown that it's back up to this high end here, and what I was looking for in Amgen was actually a break of these highs. It didn't occur, so there was no reason to purchase Amgen. Let's go to a 30-minute time frame. But, I'd say maybe keep an eye on Amgen up near about 159 next week. Set an alert, see how it acts, and that's possibly something that could help lead this, these biotechs continue to outperform. And a similar level in Celgene would be about 124. Either way, these biotechs have, the most recent relevant higher low was right here above a flat to rising 5-day moving average. And you can see how this trend developed. We've been testing this 5-day moving average, so it's getting a little bit tired here as well, perhaps. We are, I think the bigger level we want to see the biotechs hold. If we pull back down towards 333, no big deal. Even into, I would say, this level here, 331 and a quarter to 333 is our expected band of support for next week. I would like to see it pull back and kind of go sideways a little bit, build some energy for the next rally, but right now they are looking a little bit fatigued, so be aware of that. Apple is also showing some fatigue here. We had been talking about this for subscribers about being stopped out right here if you were still involved in it, because that was the most recent relevant lower low with a stop below there. It continued down through the 5-day moving average, rallied on Thursday, and pulled back on Friday. I think that you look at Apple, and it's had this fantastic run here over the last month, and it's undergoing a little bit of profit taking, a little bit of distribution. In order for it to become a purchase again at this point, and things change throughout the week, we get new information, and that's why we look at it each and every day to see if there's relevant new price information. But I think that this is going to be the key level for it to get back above in order to be considered something you want to trade for a swing trade. So if you've got your eye on Apple, be patient with it. I can't tell you how many times I was asked, is it a buy, 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 is it a buy this week? It's not a buy for a swing trade. Now, if you're a day trader, there's obviously all kinds of opportunities in Apple each and every day. We've got great range in there, and there's good day trade opportunities. But I would say if you're looking to swing trade Apple, just be patient with it. Listen to the message of the market. The message of the market is we've had this fantastic rally. It's undergoing a little bit of distribution. Let's sit on the sidelines in cash and wait for it to develop for the swing trader. For the day trader, obviously, you trade the volatility. Alibaba continues to be a piece of garbage here. It's in a downtrend. Lower prices should be expected. I mean, we did bounce back a little bit this week and had one strong day in particular, but it's still in a downtrend, primary downtrend. There's no reason to be a buyer of this. Same is true, of course, with Gopro. We had made fun of it last week because people got excited about this one day where it had a rally, and it was an impressive rally from 46 up to 51. But with a declining 10, 20, 50-day moving average, expect those rallies will fail, just like we see unfolding in oil. But the stock had news, I guess, on Friday, and it continues to be lower. This stock did not make a higher high and higher low above a flat to rising 5-day moving average, so there's no reason to buy it, especially, again, with a declining 50-day moving average. Look at the longer term as guilty till proven innocent. It's going to take time for that stock to recover. Baidu is one that I would keep an eye on for next week as a potential short sale candidate. This one has had some trouble in here recently. We've had this big rally, and it's kind of hanging on the edge of a cliff. It's below a 10, 20, and 50-day moving average. You can see it can't close back above that 10-day moving average, and perhaps next week, below the lows of this week, there's an opportunity for a short sale. I'm not going to recommend that necessarily, but you can see that this prior little support was broken and held as resistance at that declining 5-day moving average. But this is a stock that requires a lot of trading skill. It's something we'll talk about in the Alpha Trends trading room live as it sets up. But I would also say maybe keep an eye on level 3 communications, which has this nice longer term uptrend, and perhaps breaking the high of this range, it could get going. But just breaking a range doesn't mean you buy it and forget about it until next week, until I update it, because if it breaks back down, then you've got to take responsibility for these trades. The shares of Mendelez are one that looks like perhaps there's something setting up in here for next week, that we've got this recent tight consolidation. So I'd say keep an eye on Mendelez, MDLZ, maybe set an alert near about 37 and a dime. Tesla is one that looks like it's really kind of just hanging on the edge of a cliff. If we take a look at some, the volume weighted average price since the high last year, the volume weighted average price since this gap lower over here, we can do this on an intraday time frame. Since this gap lower, you can see we're below that. The volume weighted average price since the earnings gap, we're below that as well. And this stock is just kind of hanging here on the edge of a little bit of a cliff. I think that you break below this level, and ideally maybe we come down and then suck some shorts in real quick, then a fast rally up to the decline. It's a volatile stock is my point. You can't just look at this and make your plan. You've got to, unless you're going to have a big stop. But if it continues down, then I think that we could see that perhaps we could see Tesla back down towards about I'd say 180-ish or so. Does not seem unreasonable at all with a stock that has a declining 50, 100, 150, and 200-day moving average. So So the stock is undergone some distribution here. They were the car of the year again. So, good news isn't making it go up. What is? The other thing I did want to talk about quickly here was the TLT. Once again, the bonds. They broke as we were talking about. If it got back above about 128 and a quarter, we were likely to see a bounce. This is where we saw the higher high above a flat to rising 5-day moving average. So if you purchase it here, your stop would have initially gone under there, and as it makes these higher highs and higher lows, you raise your stop, and basically, it's riding a 5-day moving average higher. But this longer term trend, it seems like it's going to have to undergo at least some further correction through time. I don't think that it makes a compelling purchase candidate. Oil, as I mentioned, it was up slightly this week, but last week we spoke about guilty till proven innocent because it's got this declining 50-day moving average. Don't get excited about it because it's above that 50-day moving average for a couple days. More important is the fact that the 50-day moving average is declining, and what we had spoken about was I wouldn't be surprised to see it come back down towards 44 to 45. I still think that that's a reasonable thing for this stock, for the oil market to do. In particular, if we're back below probably 48, you can see this little band of support, basically 47.75 to 48.50-ish. Breaking back below and holding below there, I think it's very reasonable to think that we would at least get a test of the recent lows, if not to be able to continue the trend lower in the oil market. Hope that was helpful to you and that you have a good week of trading ahead. Take a look at the Alpha Trends subscription if you haven't. Thanks for tuning in.